All right, good afternoon and welcome to our series of eConnections webinars. My name is Neil Fauerbach. I'm a partner with Smith Gesteland. For those of you who don't know us, Smith Gesteland is a local CPA and business consulting firm. We're about 85 people strong at our one office in Madison, Wisconsin. We serve clients in manufacturing, supply chain, construction, high-tech, professional services, and nonprofits. We're particularly well known for our work with family businesses and for our 80/20 profit enhancement services team. We're honored to welcome a very nice crowd of businesses on this call from all around Wisconsin. We have companies in plastics, commercial printing, precision machining, chemicals, foundries, and medical equipment, and more. Welcome. We're recording this presentation for playback at any time. We will link it to our website along with the PowerPoint you'll be seeing today. If you have questions during the webinar, please use your questions function on the webinar dashboard to ask them. You will remain anonymous, and we will get to those questions if we have time at the end. If we do not, we will answer all of the questions in a follow-up email. Our presenters today are Todd Kleibor and Rick Magnuson. Todd is a CPA and a manager at Smith Gesteland in our manufacturing supply chain group. He's a CPA and a certified management accountant. In addition to traditional assurance services, Todd is skilled in designing, evaluating, and improving inventory costing policies and procedures. He also has experience in reviewing and enhancing internal controls and operating efficiencies for his clients. And an interesting factoid about Todd, Robin Yount, the famous Brewer baseball player, saw Todd hit his only Little League home run in his Little League career. Rick Magnuson is a strategic advisor in our 80/20 profit enhancement solutions practice. Rick came to us after a 35-year career with Illinois Tool Works, where he worked in manufacturing, finance, sales, and operations in many different ITW companies. ITW is a Fortune 200 company with $19 billion in revenues in 800 individual companies and over 59,000 employees. They're headquartered in Glenview, Illinois, with operations worldwide. He improved profitability and growth in over 130 individual business units at ITW. Most recently, Rick was the group controller of the ITW Food Equipment Group, where he worked with brands including Hobart and Vulcan. In other words, he's earned the right to address this topic today. Rick is proud to be from Chicago, especially after their Little League team made it to the final World Series game this weekend. Before I give it off to Todd, I'm going to start with a quick poll that I would like everyone who is here to answer. And we'll take 10 seconds for you to take a look at this and then answer. And then Todd, take it away whenever you want.
All right. Well, I believe all of you should have had a few moments to respond to that question, and we'll hold your responses until the end of the webinar as we review those and see what we've learned today. What we want to do today is just go over the objectives and learning objectives, understand the current state of costing, provide an overview of direct costing, understand the benefits of direct costing, how it's used to make decisions, how it makes decisions easier for you and your organization. And we'll take a look at some case studies as we go along where we can really see direct costing in application. We'll kind of put numbers to the philosophy and look at some examples. And we'll just then close with keys to successfully implementing direct costing in your organization. And I just off the bat here want to apologize. I'm recovering from a summer cold, so as we move along I'm going to try and muffle my cough or mute as I feel the need, so you may hear awkward pauses as we move along. So again, I apologize in advance for that. So the current state of costing, as we look at traditional costing systems, what we see is that they're often compliance driven, that inventory costing systems were really developed to value inventory for the external needs of the financial statements, for GAAP basis financial statements, for preparing tax returns, etc. And because those traditional costing systems are in place to provide the compliance objective, operationally, traditional costing isn't very effective. It makes it hard to make good decisions. Traditional costing systems are often complex, and that's because as accountants, we try to attach as many costs as we can to those products. And we'll look at our fixed costs within the organization and figure out a way to allocate those costs to all the products we make in any given period. And because we're finding ways to allocate those costs to all the products that we make, we rely on estimates in order to do that. And that's another reason that it makes it kind of an imperfect science. And those allocations and estimates are often driven by labor hours. And as we've moved away from a heavily labor workforce and we have more machines in place, that may not always be the best driver to allocate those costs to products.
Right, and if I can interject, the traditional cost accounting systems that most of us were using were developed in the 20s when labor was a much bigger percentage of the cost than it is today between technology and automation. And as we get into this, as you think about your overheads and whatever methodology a business uses to allocate those costs to individual products, whether it's direct labor hours, machine hours, or square footage or whatever, you will find that your highest volume products will take a disproportionately high share of the costs, and the lower volume products will take a lower volume share. And when our CEO, John Nichols, joined ITW in 1980, he challenged us to go through our quotes, and he was betting that we were winning most of our low volume jobs and losing most of the high volume ones, and he was right, because the high volume parts are taking a disproportionate high share of the cost base. So
those are some of the unintended consequences of the traditional costing models that we outlined here. And under those costing models, traditionally the way you look at things is you'd say, okay, well, I have a product cost and I want to make 20%. So pricing decisions would be made based upon our costs plus markup. And that really didn't pay attention to what is the market willing to pay for this product. So the market really drives the price of the product. So the formula should be something else. It should be, what can we sell this for, less our cost to make that product, and that equals your contribution margin. So it's a different way of looking at pricing decisions. And Rick, I think you've said this before, but the price really is set by the market, and it's set by your
stupidest competitor.
So this kind of flips it on its head a little bit and provides us a new perspective to look at things. So what then is direct costing? Direct costing is an accounting method used for both valuing inventory and calculating your income. And how it differs from traditional costing systems is that this requires you to separate your manufacturing costs between those that result from volume and those that result from the passage of time. So really, as you think about that, the volume-related costs are variable. Those are the costs that are incurred because you are producing inventory, because you're manufacturing something. And the passage of time are things that are fixed, that are going to be there and don't vary based upon your production level. So it would be the same whether you produce 0 units or you produce 100,000. And that could be things like rent, depreciation, maybe utilities, but things of that nature. And what direct costing does is it says, now that you've separated and identified those fixed costs and those variable costs, that those fixed costs are not allocated to inventory. So what you do instead is you just expense them on the income statement. They just get expensed as incurred, and they're treated as a period cost. So examples of variable costs then may include direct materials, direct labor, fringe benefits, your purchase price variance on your raw materials, scrap and the manufacturing process, freight, inventory adjustments, supplies, packaging, etc. And again, those fixed costs or those sunk costs that are going to be there regardless of the level of your manufacturing activity are things like your manufacturing salary labor, any indirect manufacturing labor the organization has, depreciation, rent, insurance, taxes, utilities. And a little caveat here is that there's no magic bullet in terms of trying to figure out what cost belongs in which one of these two buckets. That this analysis is going to vary by company and by industry. You may have a company where utilities are the same regardless of what the production level may be, and you may have another company where a large portion of the utility bill is fixed, that it's not going to vary from month to month. And maybe 50% of that bill should be in fixed costs, and 50% of 1 month's bill is variable. But there may be splits here. And Rick, I think you have some good anecdotes.
Yeah, we've had businesses. We had a business at ITW where we made electronic keyboards before they became disposable, and the packaging cost actually was a variable cost because we needed to package every board a certain way. When I was running the screw business, you ship screws, you ship 40-pound boxes with 48 pounds of screws in a box, so that we expensed the packaging. The packaging became a period cost. And as I said, when John Nichols came to ITW and brought this, it transformed our company. We started looking at business much like most of us look at our personal lives. In other words, most of us, you have a mortgage, you have taxes, you have utilities, you have insurance, and if the amount of take-home pay you bring home is not enough to cover those expenses, you're going to have a problem. And it's no different in the way we look at a business under direct costing. We have this pot of overhead costs that we're going to incur every month, and if our contribution margin dollars don't cover the overhead costs, we're going to lose money that month. And it's all about, pretty simple, here's what we're going to spend. We need to make sure our contribution margin exceeds that.
So then some of the benefits of direct costing is, because direct costing just focuses on those variable costs, those costs that are only incurred if you produce that unit, that batch of product, it really simplifies that product costing. Your overhead costs then are more easily tracked and managed on the income statement. They're going to show up on their own line. There's not going to be any of that overhead allocated to inventory and absorbed or under-absorbed. It's just going to be $300,000 a month, whatever that number may be. And because of the format of the income statement, it makes it a lot easier to analyze and plan your financial statements. If you know you were producing and selling at certain levels in 1 month and sales are forecasted to increase the next month, how's that going to play out on the income statement? What is your net profit going to be for that next month? And these next 2 points, I think, kind of really drive at the crux of direct costing, and that's when you implement direct costing, there's no income statement benefit from building inventory. And likewise, there's no income statement detriment or reversal from reducing those inventory levels. So you don't take a hit when you reduce inventory and you flush additional costs through your income statement. And we'll get into some of these benefits in our case studies so you can kind of see them with numbers behind them. And I think it'll really bring the point home at that point. So just to reiterate then, direct costs are those costs that are controlled at the operating level. And operations monitors and manages those costs, and really they have ultimate responsibility. If you're going to evaluate an operations manager, it should be on those costs that they can control, those direct costs. The indirect costs then are controlled at the management level. Those are the costs that are fixed in nature. They have little variability from month to month. It's just that $300,000 of costs that you're going to incur regardless of your manufacturing level on any given period. And so one of the benefits then of direct costing is that your pricing decisions become easier. Your product costs that are in inventory are just your variable costs. So then you know that if you can sell that product for anything greater than the variable cost, that you're going to contribute those extra dollars to that fixed cost base, that $300,000 that you have to cover every month. So we'll look at our first case study here and just try and, again, put numbers to some of the theory here and try and understand this. So in our first case study, we're going to assume that our company is operating with a full absorption costing environment and that our facility has capacity. And a customer calls us up and says that they want to place a special order and buy some widgets at $18 each. And the sales manager looks at the inventory costing and pricing and says, well, it's going to cost us $20 each to manufacture that product. So in this instance, the sales manager is likely to turn down that order because that fully absorbed cost exceeds the price that the customer is willing to pay. So they're going to look at that opportunity and say, no way, I'm going to lose $2 per unit on that sale. You know, they're going to walk away. And again, you know, the key point here is just that fully absorbed product cost includes a portion of that overhead that is allocated to that product. So if we were to then look at it, if we had a direct costing environment, the first thing we do is that we'd modify that product cost. And we would separate the variable costs from the fixed costs, and those fixed costs would just get expensed right to the income statement. So we, in a sense, we're going to peel out $7 of fixed costs from that product cost. So now our direct costing product cost is $13 per unit. And again, that customer calls us up and says, hey, I'd like to place a special order and buy product for you at $18 each. Now the sales manager is going to make a different decision based upon this information, because here they understand that I only need to incur an additional $13 per unit to sell it for $18 per unit. So that will contribute $5 per unit to the fixed cost base that I'm going to incur whether I accept this order or not. All right. Apologize for that pause. I muted my cough here. So now as we look at case study 2, here we're going to look at an example where we have 3 different products with 3 different cost structures to each product. So product A has a sales price of $15 per unit, a direct cost or variable cost of $10 per unit, and allocated overhead of $4. So under full absorption, product A would be inventoried at $14, has a total cost of $14, so it would generate a profit of $1 per unit, and it would contribute $5 per unit to the fixed cost base. And again, that's that sales price of $15 less the direct cost of 10. It's going to contribute $5 to the fixed cost that we have to cover every month. Product B sells for 10, direct cost is 7, allocated overhead at 280. So it's still going to provide us with some profit of 20 cents per unit and contribute $3 to our fixed cost base. And product C is where it really starts to get interesting. Here we have a sales price of $40 a unit. Our variable or direct cost is $36. So it's going to contribute $4 per unit. But after we allocate the overhead to it under a traditional costing system, it's going to have a total cost of $50. So as we look at the numbers under a full absorption environment, we're going to understand that we're going to lose $10 every time that we sell this product. So given this set of facts, the question really becomes, which one of these products would you concentrate your marketing efforts on? Some might say C. They may just want to maximize sales dollars and say, you know what, it doesn't matter if I think we lose $10 per unit or it only contributes 4. I just want to drive up and maximize my sales dollars, so I'm going to focus on product C. Others might look at it and say, well, I'm going to focus on A. A contributes $5 to that fixed cost base that I have to cover every month. So that's where we should focus our efforts. And some may even look at it and say, why are we even producing C? We lose $10 every time we produce it. What we really ought to do is discontinue that product, so then we can just sell A and B and we'll make even more money because we won't be losing $10 per unit in that instance.
Right, and let's think about product C for a minute. If the business decides, and I go back to ITW in the 70s, and we actually did have this, and we jettisoned a few product lines that we shouldn't have, but let's say the business decides to get rid of product C. What'll end up happening is the overhead pot doesn't change. I mean, you still got the same rent and the same real estate taxes, but those expenses now get reapportioned back to product A and B, which are the remaining products. So what happens is, through no fault of anything, product A and product B's costs will go up. And it looks like they're contributing less margin and losing more dollars. But the reality is nothing changed. And we'll get into it on the next example, but we actually had a case at ITW where we were in the process of buying a company. We bought 300 companies in a 10-year period. And one business, the owner said to us that the third largest customer was a $2 million customer, but on a fully absorbed basis only had a 20% gross margin, and that he was going to get rid of that customer before we bought the company. And we told him, look, don't do anything. We'll sort it out after we buy it. So we bought the company, and then we sat with him and said, okay, let's go through. We're going to get rid of this customer, $2 million at 20%. So we're going to lose $400,000 in margin. So here's a piece of paper and a pen. Tell us the $400,000 of overhead cost that leaves the business because we're getting rid of this customer. And if you can't do that, then the bottom line will be dilutive after this. Well, he couldn't come up with $400,000. So then what we did is we reran all the product costs based on a direct cost basis that customer bought, and the contribution margin of the products that customer bought was 45%. So the $2 million was contributing $900,000 a year to cover the overhead costs of a business, which would have been a suicidal decision to get rid of that customer and the perceived 20% margin. What this also does, many companies that before we got into this, were running their businesses based on percents. And I know those of you listening that I've been working with, we don't take percents to the bank. we take dollars. And it's a very simple concept when you're talking to your own employees, trying to teach them about P&Ls and profitability, and say, here's $500,000 a month of cost. If our contribution margins of what we sell don't cover $500,000, we will lose money. And if you had a $20 million business and you made $2 million, you make 10%. If you have a $23 million business and you make $2.2 million, you don't make 10%, but you have $200,000 more in profit. And that's it. You know, we take dollars to the bank. We don't take percents. But this became a very simple way for us to educate our managers on what we really mean by profitability, as opposed to getting into under-absorbed burden, over-absorbed burden, allocating costs. Much simpler and much more accurate.
That's a great story, and I think that helps really illustrate the differences here, in that it's really about maximizing the contribution dollars to the organization to cover that fixed cost base every month. So as we move on then to our next case study here, what we're looking at is two different income statements, one under full absorption and one under direct costing, and they're both looking at the same 2 months, and we're just showing that activity under the two different formats. So what we see in January under the full absorption, which is on the left, is sales of $100,000, and then what follows is the costs that are in inventory that are going to flush through the income statement as we sell inventory. So for $100,000 of sales, we're going to have raw material of $25,000, variable labor of $15,000, variable overhead of $20,000, and then the fixed overhead that was attached to that inventory when we made it of $20,000. Our fixed overhead for the month is $20,000, but because we anticipate a future need for inventory, we actually had a big inventory build month. So we over-applied, so we allocated $25,000 of costs of fixed overhead to inventory in January, even though we actually only incurred $20,000. So because we over-applied our inventory, we kind of have a pickup here of $5,000 in January. So that shows our gross profit for the month then of $25,000, and we've captured $5,000 of fixed overhead costs into inventory at month end. So in this instance, we show that we have gross profit of $25,000 on sales of $100,000. So in February, let's say we're projecting $125,000 of sales. One would expect that then maybe our gross profit would be $30,000, that we'd see an increase, because we know we make money on each sale here. So sales increased 25%. Our raw material, our variable labor, our variable overhead, and fixed overhead all increase 25%. So now our total costs running through the income statement related to inventory are up from $80,000 to $100,000. We still have that same $20,000 of fixed overhead that we incur every single month. But in month 2 here in February, we didn't have an inventory build month. Inventory stayed flat. So we applied exactly $20,000 of inventory, and what happens here is, again, we have a gross profit of $25,000. So even though we've increased our sales 25% and we increased our margin, we ended up with the same gross profit number for the month. And that makes it really hard to explain in a monthly financial statement review the financial statement results of the organization, because on the face of it, this just doesn't seem to make sense. So if we kind of leave that one alone now and we turn to the direct costing example on the right side of your screen, again, same set of facts. We have sales of $100,000. Now the costs that are going to run through our income statement because we sell inventory are just going to be those variable costs. So it's just going to be our raw material, our variable labor, our variable overhead. So we have total variable costs of $60,000 run through the income statement, providing a contribution margin of $40,000. We have that same $20,000 of fixed overhead that we incur every month, so our gross profit in January is 20%. In February now, again, we're projecting increase in sales, so how does that drop down to our gross profit line? And again, you'll see with the increase in sales that our total variable costs are going to increase from $60,000 to $75,000 and provide contribution margin of $50,000. We still have that same fixed overhead amount of $20,000, so here our gross profit is $30,000. So, just looking at this income statement and the impact of increased sales, it shows that under direct costing, what your income statement does is actually show you the results of what you sell. Whereas in a full absorption income statement, it often shows you the results of how much inventory you made, not necessarily how much inventory you sold. And that makes it really hard to predict the future, to analyze your financial statement results and understand what's happening and why it's happening.
And keep in mind, I mean, people get this, and typically when jobs are set up on the shop floor and they're running good, and people get the fact that profitability improves if I build inventory, I mean, you may end up with way more inventory than you thought, but the machine is set up, the job is running well, I'm just going to keep running it, and you end up with inventory, you overabsorb, you have a great month, sales outlooks the next month to be significantly higher, you go through, the accountants go through the P&L outlooks or projections, and the reality is you usually don't tie to that. Your results tend to fall short because of the big build the month before. And look at the direct costing income statement. It's much simpler. As ITW was training future managers, future general managers, it's a much simpler P&L to explain than the one on the left, where you're trying to explain applied overhead, unabsorbed burden, way too complicated. Direct costing is a much simpler, much more accurate tool.
So, using this format and this approach, we'll kind of change the facts a little bit, and we'll say that your largest customer wants a 10% price reduction. And
never happens to anybody, by the way.
Well, they're always willing to pay more.
Right.
So in order for an organization to analyze the impact on its business of what that 10% price reduction would do, under full absorption, it's really hard to understand, well, how is my gross profit going to change given a 10% price reduction? Whereas under direct costing, to Rick's point, the format is much cleaner, it's easier to understand. Those fixed costs are just down below. So in the top 2/3 of this chart on the right, if your sales are going to increase by or decrease by 10%, but your variable costs are going to stay the same, what impact is that going to have on my contribution margin? And is that still going to cover my fixed overhead costs that I incur every month? And how is it going to affect my gross profit? It's a lot easier to analyze that situation. As we move on to yet another case study here, what we're really going to do here is try and contrast again the direct costing and absorption costing and the impact on financial statements. So We just need to kind of take some time to set the stage here with some assumptions. So we're going to assume that we make machines, and the selling price of each machine is $37,500, and our manufacturing costs comprise of the following. We have direct costs, or those variable costs that are incurred for each machine that we build, of $15,000. And we have period costs of $50,000 per month. And again, those are costs that are going to be incurred whether we produce 0 units or 5 units. We're also going to assume that we have selling, general, and administrative expenses of $20,000 per month, and that our normal production volume is that we can produce 5 machines per month. Okay, so if we're going to produce 5 machines per month under full absorption, we have period costs of $50,000 per month. So we'll have $10,000 that we attach to each machine that we build of our fixed overhead or period costs. And under direct costing, those costs won't be attached to the inventory. They're just going to show up on the income statement. And down below in our chart, we just kind of lay out 3 months of activity. So despite the fact that we can produce 5 machines per month, in January we produce 4 and we sell 4. In February we are going to produce 5. We're going to sell 4, so there'll be 1 remaining in our ending inventory at the end of February. And then in March we only produce 3, yet we sell 4. And the key being here that our production level changes in every single month, but what we sell every month is the same. We're selling 4 units 3 months in a row. So as we look at the income statement on these, we can kind of see how this plays out. And I just find this fascinating that under absorption costing, we sell 4 units at $37,500. So each month we have sales of $150,000. Our cost of goods sold, again, that's the costs that flow through the income statement that represent how the inventory was valued. So under full absorption, we had variable costs of $15,000 per unit, and we had fixed costs of $10,000. So we had that $50,000 of manufacturing costs, and we can produce 5 in a month. So for every one we build, we attach $10,000. We sell 4, 25,000 times 4 is at 100,000. And in January, we only produced 4 units, even though we could have produced 5. So we had unabsorbed overhead of $10,000. So that results in a gross profit of $40,000. The manufacturing or period costs are ignored in this example and will show up in direct costing. SG&A expenses at $20,000, so our net profit in January is $20,000. Now in February, again, sales of 4 units, so sales and cost of goods sold are unchanged. We actually built 5 units in February, so there is no unabsorbed overhead flowing through our income statement in this instance. So that increases our gross profit to $50,000. SG&A is the same as it was the prior month at $20,000, and our net profit increases from $20,000 to $30,000. But now we have inventory at the end of the period, and that inventory is $25,000, and that's made up of the $15,000 of variable costs and the $10,000 of fixed costs that we attached to that unit when we produced it. Now in March, again, the facts change. Again, we sell 4 units. We only produce 3. So in March we have unabsorbed overhead of $20,000. So our gross profit decreases from the prior month to $30,000. SG&A is the same at $20,000, so our net profit decreases to $10,000. Under direct costing, sales are the same as they are under full absorption. That cost of goods sold line represents just the variable costs that were attached to that inventory. So that $15,000 per unit. And there's no underabsorbed overhead. we pull that overhead out, and we put it down below. So here we sell the same number of units each month, so we have the same gross profit of $90,000 in January, February, and March. And those manufacturing costs, again, we treat as period costs. So those just get expensed in the month that they are incurred. So we expense $50,000 in January, February, and March, regardless of our production level. And SG&A, same thing, $20,000 of expenses. And here you can see your net profit each month is $20,000. So what this is really illustrating here is that under direct costing, your net profit is driven by the sales. Under absorption costing, our sales are the same every month, yet every month we are showing a different net profit because our inventory production level in these 3 months were different. So it just becomes really hard to use those financials as a management tool to understand your business, to plan for future months given changes in sales volume, etc. Rick, I don't know if you have anything else to add on this case study here.
Again, if you look at these and somebody, if you were under fully absorbed accounting and somebody said to you, okay, we're going to ship $200,000 next month. I mean, it would be a crapshoot to try to figure out what the net profit would be, right? Because then you got to get into, well, what's my inventory build going to be? Am I shipping out of inventory? Am I building inventory? Under direct costing, it's pretty simple. I'm going to have 200,000. I've got the same 50,000, and you go from there. It just makes forecasting and outlooking. And again, ITW is a publicly traded company. You know, we give outlooks every quarter. You have to give the next quarter outlook. You have to give the next 6-month outlook. And the real crux of a publicly traded company is what? It's earnings per share. Earnings per share is after-tax income divided by the number of shares outstanding. It's not percent per share. It's not revenue per share. It's earning dollars. And, you know, again, there's a big effort and emphasis in our company, or was, on forecasting and outlooking. And under fully absorbed accounting, we were terrible at outlooking. But under direct costing, we got pretty darn good at it.
So really, I think what this speaks to is the power that direct costing has for the internal management and understanding and forecasting and knowing that if X happens, here's the impact that that's going to have on my business. The caveat, though, is that direct costing is not GAAP. You know, this is not meant to provide information for your GAAP basis financial statements, because GAAP requires that all charges, whether they be direct or indirect, that the organization incurs to bring inventories to their existing condition, be capitalized. So what direct costing is it's a management tool, and if you're going to implement direct costing, you need to understand that it's going to need an adjustment to bring the financial statements to GAAP basis. And that can be done on a monthly, quarterly, some sort of regular basis. So the keys...
Let me go back, and it really is only revaluing the inventory between WIP and finished good that's on the balance sheet, right? Because the inventory is only at variable cost on the balance sheet. So what GAAP says is you need to basically somehow simulate that those are fully absorbed. And the calculations are, I mean, we had 850 business units and they're all doing it different ways. But at the end of the day, it's materiality, and, you know, all you're really trying to do is step up WIP and finished goods to a fully absorbed basis.
Right, so if you know that typically you had that fixed costs made up 30% of the fully absorbed, or were 30% of the variable costs in that unit. That then at month end you just look at those variable costs and you say, okay, I need a pickup of 30% to capture the fixed costs that are not currently being reflected in inventory, and put that on inventory on your balance sheet for that month end, quarter end, whatever it may be. It can be a fairly simple calculation.
And just one other thing that we did, because most of our managers were on an incentive basis, and what we didn't want to do at the end of this quarter or year is step up the inventory and have the other end of that entry still be an impact positively to their incentive for building inventory. So what we did is, where the debit goes to inventory, the credit was a below-the-line credit, below op income. So none of our managers were incentivized to build inventory, even on direct costing.
Okay, so that kind of gets into some of the how to successfully implement direct costing, because there's still motivations, and people will learn the game fast, and they will know how their behavior impacts their incentive plan, whatever it may be. So just to look at some of the keys to a successful implementation, the first one is just that you need to identify and agree on those costs, to separate the variable costs from the fixed costs, those that are controllable by operations and those that are controlled by management. You'll need to set up an income statement that's a little bit of a different format than you're used to. It'll have to be a direct cost formatted income statement. And then with that, we just kind of talked about converting that direct cost statements to GAAP basis. So you'll need to set up the conversion entries to convert from GAAP to direct costing, and then the quarterly inventory step up and the entries to attach those fixed costs to your inventory on a regular basis, and what the method is going to be for that, whether it be 30% of your variable costs, whatever it may be, given your cost structure. And as anyone knows, in order to have information and understand activity in the past and how the current period relates, you're going to want to recast prior periods. That way, as you look at any month's information, you can have comparable information to compare it to. And again, just run parallel for a period of time and not do a complete conversion. Make sure that you kind of work out the kinks and you can understand the nuances of it. And here, this is a little small, but this is just an example of what a direct cost income statement may look like. And if it's too small for your screen, really what it has is it starts with revenue, and then the next group of expenses is your variable expenses. Those are those direct costs, the only costs that are incurred as you manufacture additional product. And as you subtract those away from your revenues, you end up with your contribution margin. And the next section here is period costs, those costs that are incurred whether you manufacture 1 unit, 10 units, 20 units, whatever it may be, which gives you your gross profit, then your SG&A costs, and then down to your operating income. And Rick, I think what you were really speaking to a few slides back was that even the adjustment from direct costing fell below this operating income line.
Right. Our managers were pretty smart to know what drives their bonus. And so what we did is the offsetting entry to this went below op income, so there was still no incentive for them to build inventory.
So, we hope that today's presentation gave you a little bit of a flavor for, I guess, what direct costing is, what its benefits are, that it's really meant to be used as a management tool, and as we looked at a few examples and case studies, that it's a lot easier to analyze the business, to maybe change a forecast and understand and have a better understanding of what your results are going to be in the future, given if business increases 20% with a customer or a customer asks for a discount. How is that going to impact my business versus under a full absorption environment? So at this time, I don't know if anyone had any questions that they've typed in. Neil, I don't know if you want to chime in with any that you've seen.
They haven't, nothing as of yet. Can you hear me?
Yes.
Okay, good. No questions as of yet, but there is an awful lot of attentiveness and a pretty good crowd out there. We will be following up with the recording of this webinar, and also we'll be putting the PowerPoint up. As you leave the webinar, you'll be asked to answer a couple of questions that help us improve these webinars. We're looking for ideas for what else you would like to see. We will be putting out an email with some of the frequently asked questions that do come up when we talk about direct costing. On the screen you see sgcpa.com. That's where you'll be able to find the recording of the webinar as well as the PowerPoint itself. So please take a moment to complete the short survey. If you've got questions, there are the email addresses for both Todd and Rick, who did a fabulous job this afternoon. One of the questions that we will ask is actually an offer for a free consultation on direct costing. So take a look at that, answer them. We appreciate your time. Thank you very much. Have a great afternoon.
Thank you.